With the government shutdown dominating headlines this week, it's worth asking how much politics should actually factor into investment decisions. The truth is, much of what we see in the news is showmanship. An advisor's job is to cut through the noise and focus on what truly impacts markets and portfolios. You'll often notice that during a government shutdown, markets don't fall dramatically, and that's because investors know it's largely political theater. Historically, a resolution always comes after a few weeks, and markets price that in long before the headlines fade. Where politics does matter is in the underlying policies that shape the economy. Things like tax law, interest rates, and government debt levels. High debt can raise long-term treasury yields, which may create opportunities for investors willing to hold through volatility. Changes in tax policy can shift how portfolios should be structured to minimize liabilities. And the independence of the Federal Reserve is critical. It's what keeps inflation expectations anchored and markets stable over time. Tariffs can also have an impact, but unless they directly affect your company or your industry, their broader effects are often temporary. That's why economists, not politicians, tend to be better guides for understanding long-term implications of those tariffs. So yes, we track politics, but not through a partisan lens. Poor fiscal or monetary decisions can come from either side of the aisle. The goal isn't to predict every twist in Washington, but to stay disciplined and avoid emotional reactions to the news cycle. Those with steady hands and long-term plans tend to come out ahead. If you find yourself unsure how political developments could affect your portfolio, it might be time for a conversation. A skilled advisor like those at RIMAC can help you separate noise from signal and build a strategy that stays focused on what really drives results. Your goals, not the headlines.